Hello everyone, it's your boy Captain Joe here from Fishing for Pips, the greatest institute of learning on planet Earth, where people come and learn forex trading and stock trading and actually make money, experience true financial stability and independence. Learning to trade on your own professionally with insider knowledge, professional education, and you're going to apply that to financial markets to succeed and win, extract good money, and create a better financial future for yourself and your family. So if you're looking to learn professional level trading, pro trader processes, professional trading approaches, definitely you want to start at Fishing for Pips. Check us out on YouTube, also our Instagram, Facebook, TikTok, and also check out our website. Today, what I'm going to share with you guys is the professional money management and risk management approach that we take on the professional side. And I'm going to show you the wrong risk management approach that is developed in the retail trading world and why traders always blow up their trading account, can't protect and preserve their capital properly, no matter how much they're taking 1% per trade, 3% per trade. They're not risking more than 1% of their account or 3% of their account, or only use as 0.01 for every 100. Whatever they try to do around there still leads to taking their account straight to zero. Alright? So I'm going to show you guys the difference between what we do, how we do it, how the retail traders do it, what are their concepts, what are their precepts, what are their perspective, their approach, their application to risk, and our approach and application to risk, and why we never blow up and lose 10, 15, 20 trading different trading accounts. We don't lose 10, 20, 15 different trading accounts. Right? We preserve our money to bear fruit for us long term. We think about our money differently. We be different towards it. We are wise stewards, discipline, obedience, good managers. Alright, so all retail traders were taught for every $100 they use a 0.01. For every $1,000 they use a 0.10. For every $10,000 a 1.00. So this is a standard lot, mini lot, micro lot. This is 10 cents per pip, $1 per pip, $10 per pip. So if you got 20k, they use 2. If you got 30k, you use 3. You got 40k, they use 4. And vice versa, they will do the same. From 100, if it goes to 200, 0.02. 300, 0.03. 400, 0.04. Same thing here, 1000, 0.10. Yeah, if it goes to 2000, nice, then they use a 0.20. And every time they increase their account, they keep raising the lot size, not knowing what they're literally doing is exposing themselves to more risk and more risk and more risk and more risk. Every time that they raise up their lot size like this, every time their account increase, more risk, more risk, more risk, more risk, more risk. So when they have a little losing streak or something goes wrong, it gives them a kickback 10 times, 15 times. Lose back everything that they made in the last 3 months, the last month, because they think, oh, this is how they were taught. It's not their fault, but the retail world, the retail concept, this is how everybody was taught in the retail world to manage their risk. You will see this on multi-level marketing companies that teaches trading with products and services. You will see this on YouTube. Nice. Now this is not the real way. This is the false way. This is the wrong way. This is the wrong approach. This is what will lead you to destruction. So just imagine you having the wrong information, the wrong education, the wrong approach, the wrong strategies, and then using this thinking that you're real good, you have a very good risk management strategy, and you're using the wrong things surrounding risk too. So I'm going to break this down. So somebody asked me, Joe, with a $10,000 account, what lot size should I be using? You see, they think about lot size directly off of their capital. You're not supposed to have a $1,000 capital and be thinking that, what lot size do I use with $1,000 capital? Because if you ask that question concerning your total investment, your capital in your trading account, you will follow this rule of 0.10 for every 1,000. And you will arrive to a place of using this type of lot size for that capital. We don't do it like that. Right? And when you start to grow your account into 2,000 and 3,000 and 4,000, you start to move up to 0.20, 0.30, 0.40. Because you are keeping the total capital in your head and then you are raising your lot size, but remember, you're exposing yourself to more risk. So, I want to break this down to how we actually do it. Because if you keep thinking about that, what about when you reach 100K? When you reach $100,000, you want to be using 10 standard lots. Because you got a $10,000 capital, and because you're thinking one standard lot per every $10,000 that you have, you think that when you hear this is the the lot size that you're using, 10.00. Right? So, do you know how easy it is, how fast it is to lose $1 million in trading? $100,000. Do you know you can lose that in one day? Do you know you can lose that in 2 hours, in less than a day? So, let me break this down for you properly. How do we calculate it? Our lot size arrived from, so the first thing, we have money management. Money management. This is where we look at our total capital and we take 10% out of it to build our portfolio for that quarter or for that month. So we look at our total capital, 10%. So now, this is the calculation we use, guys, for money management. 10% out of our $10,000, we have $1,000 that we want to expose on that portfolio for that month or that quarter. Then we will now look at our trade ideas. So, okay, we have 2 buy positions that we want to put on, 2 sell positions that we want to put on. Now, what we can do with that is, how much lot size we want to use here? We want to use 50 pips. 50 pips. I mean, how much stop loss? What stop loss we using here? From our entry to where our stop loss is 50 pips. So we put in 50 pips across all of them, equally weighted for simple calculation for you all to grasp the concept. So what lot size can we use to stay within this $1,000? So we have $9,000. We have 9K, safe and sound. Cannot blow that at all. Can't lose 3/4. Can't lose half of our account because we took 10% out of our total capital, and this is the money that we are allocating across these different positions that we have on here, and we gotta stay within this perimeter. So we could use for whatever stop loss, whatever lot size, whatever stop loss range we're working with, we can arrange that lot size accordingly to make sure that we allocate a certain dollar value per position and still stay between this. And we do not have to just use a 0.10, nice, for every $1,000, because we could use a 0.2, we could use a 0.3, we could use a 0.5 and still stay within there. Nice. So if you have a 50 pip and we're using a 0.2, so which means we expose $100 here, $100 here, we expose $100 here, and $100 here. So we spend $200 up here in those 2 buy positions, 200 down here in these two sell positions. So overall, net spent $400 in risk. We still have $600 to go. Could I use a higher lot size now? Could I use a 0.3? 5 trees are 15. So we have 150 here, 150 here, 150 here, and 150 here. Alright, so now we got $300 exposed here, $300 exposed here if we're using a 0.3. Nice. So that's 3 and 3 is 6. So now we got a $600 exposure. We still have $400 remaining. Could we add 2 more positions on? Or could we use a bigger lot? We could, if we use the 5, it's 250 here, 250 here, 250 here, 250 here. That makes up $1,000. Nice. And anything goes wrong, can't blow up, can't lose anything. We're still using a decent lot size. Nice. That makes our return becomes bigger. Nice. We have the purchasing power of the 10,000, but this is the dollar value that we are exposing. We're not just looking to, okay, I have $10,000. What lot size I should use? And just saying, okay, I should use a standard lot. This is how we actually do it. Not like how retail traders think 0.01 for every 100, and every time they start adding on, they're actually raising their risk. We are still raising the lot size according to how we are. We can still raise the lot size, but we stay within our risk. We don't blow up at all. Never, ever, ever do we blow up. Yeah, there is no blown accounts. It doesn't exist in our world. We are disciplined and obedient, good stewards, good managers towards our capital. We have to respect our capital, be different towards it. You know, we have to treat our capital with respect. Yeah, we have to deal with our capital because our capital is what keeps us for the next portfolio. And the next portfolio, you need money to trade. All right. So this is how we actually break it down. So money management first, then what we allocate in the calculation now, dollar value per position, that is now the risk management and the lot size. So our lot size arrives from the money that we take out of or the money that we take out of our total capital. That is where the lot size arises from. The lot size doesn't arise from directly from how much money we have in our trading account. So retail traders, okay, Joe, with a $10,000 lot size, with a $1,000 lot size, with 100, I could use a $100 lot size and still use a 0.05 and still only spend $20 from this. Yeah. So this is one thing that people also have wrong. The next thing that they do wrong, the next thing that retail traders do wrong is never risk more than 1% to 3%. Never risk more than 1% to 3% per trade. So this is what they're saying. Don't risk more than 1% to 3% per trade. Okay? Let me break this down for you now. This means when you take a trade, there is no setup breathing room in price. There is no setup breathing room for price to fluctuate without you getting stop out or getting hit stop loss or hit break even, hit stop out or hit break even. So majority of them, even if they have the market direction right, is stop out break even, stop out break even. It's barely going in that direction and actually making money. But some of them say, I'm only taking 1% per trade. How much trade you take for the day? You took 24 trades. So 24 by your 1%, like 24%. You only risking between 1 and 3% per trade. How much trades you take for the day? Yeah? You take all kind of 20 trades, 50 trades, 30 trades. Right? You take 30 trades for the day, for the week, whatever. 30 trades. How much is that? 3%. 90. This is what they are doing. Now some of them, GU, they have multiple positions going up there. 0.25, 0.25, 0.25, 0.25, 0.25 on the same pair. What do you think going on with them here? How much risk you feel to take there? 1% to 3%? Yeah? As the market swing against them, lick them up. And they're going to try that a couple of times, multiple positions. So why just don't add all the lot size together? 2.5, 2.5, is that alright? 0.5, 2.5, 2.5, right? Okay, good. Let me just drop a whole standard lot on it and down the story. What is all these multiple positions about on the same pair? You already disrespect your money management, your risk management. You already over leveraging. Long time. Some of them looking for sniper entry. Do you know what sniper entry is? It means a guessing entry. A live candle coming all the way down here. And then clicking by on a live candle, expecting the market to reverse. Hoping that it reverse. Yeah? Hoping that it reverse. And talking about sniper entry on the 1 minute, 5 minute, 15 minute, talking about sniper entry on a live candle. And many times the market just come and push you and bang, hit them, bang, or even blow their account because the kind of lot size they're trying to snipe on that entry, they're over leveraging the account. That makes them revenge trade, over trade, and do all these type of bad things. This is retail education that makes people develop these bad things, these bad habits, these bad attitudes, these bad practices, these bad approaches. Alright? And majority of you all are being taught this. Yeah, so you're using a 1 to 3% per trade and not understanding what you're doing. And by the time you get stopped out, you get hit out, you try to revenge trade, make back the money that you lost, you don't forget about that 1 to 3% and you just risking all type of craziness now. Now, a candle is open and fluctuate, might leave a big pin there, leave a big pin there. So a price can fluctuate on a live candle between 20% going up, let me say 25% going down before the open high low close. Great. So if you have an entry between a live candle there and you only risking 1% to 3% per trade, which means if your entry is here, your stop loss is very tight. So as the market fluctuates, stop you out. If it do go in a direction as you actually take a trade, you're so ready to run and put your stop loss and profit, move your stop loss from here and bring it up above your entry, the market pull back down and stop you out. So you again stop out the break even, so you're not really making no kind of money. What we do is when we do things like this, we have up to 25, 50, 75, 100 per parameter with our stop loss. We have room for price to fluctuate. So when we see a peak low, we put the position here. We have a peak high, come down. We see the peak low. We expect price to go up. Okay. We put our buy stop there. We put our stop loss. If this level, and this level is 100 pips, ADR times 3. ADR times 3. This is our first level is 100, second level is 100, third level is 100. Our entries here, we taking a whole 100 outside of it for ourselves. So we take a whole ADR for ourselves. So even if price come back down, dip a little bit, dance around a little bit, by the time price turn around and do go in our direction, we good. But if you have your 1%, 2% stop loss right there, your 1% to 3% will have your stop loss so close to where price is. It stops you out and then go in a direction. You need to stay in the trade to actually make money. The market is a fluctuating tool. It's like fire flaring. You can't go close to fire, otherwise you'll get burned. Same thing with the price candlesticks. It's like a flaring fire. You can't go too close to it with your stop loss parameter. You will get burned. You have to limit your risk, slow down your lot size volume, expand your stop loss, and let the market get time to actually turn and go in your direction. Drawdown is not a problem. You cannot come out here trying to get sniper entry going profit, no drawdown, and feel you operating like a business and a good trader. You're just doing foolishness and you're making videos and going out there and trying to convince people that is the way to trade and that is the way to become successful. That's foolishness. Right? So you have to actually make sure that you have breathing room, because it's not about perfect entry, it's about perfect direction. Nothing wrong with going into a drawdown. Nothing wrong with price fluctuating around your entry for 2-3 days before it actually go in your direction. Right? You will catch volatility and you will end in net profit, and that's why you have to broaden your time span in trading and don't be so short term too. Day trading and scalping don't work. You have to take time to catch your volatility. Alright? So the people who are expanding their stop losses, nice, and looking at the cycles, the levels, the counts, nice, and building out their portfolios, those are the people who are really successful and doing well. Catching good trades, keeping their money, keep adding to what they make. But for all the retail traders outside of that, nice, who are literally learning bad stuff and doing that, they are killing themselves. So I hope you guys learned something. You want to learn more, head over to Fishing for Pips. Again, check out our YouTube, TikTok, Facebook, Instagram, and our website, DeepSeek, ChatGPT, Google, anywhere. Check out Fishing for Pips. Nice. If you want to learn professional trading, see you on board. Welcome in advance. Learn this good stuff. I'm telling you. 2026 is your year of getting rich, getting wealthy, or at least starting to get there. Better understanding the market, better professional approach, stay away from that retail stuff. It will make you poor. And all the people who teaching it and the people who learn it will learn something different, because that doesn't work. Thank you very much. Hope you guys learned something. See you guys on the next side.